All right, well, those are lots of views coming in. Let's get some more. Taimur Baig is Managing Director and Chief Economist at DBS Research Group. Taimur, good to have you with us here. Thank you very much for your time. Appreciate it. So what's the verdict for the budget? Does it move the needle either which way from a financial market point of view, Taimur?
I think from a bond market point of view, it's relatively constructive. I'm not really sure about the equity market, given the points that were just raised in your earlier piece, that between the pressure on EMFX, as well as the arguably high valuation of the Indian equity markets, the long-term capital gains may well be a bit of a cold water on the financial market outlook as far as equities are concerned. But credit and bonds, in my view, are neutral to positive out of this budget. The budget is playing the long game, focus on the supply side, do things to boost productivity, both on the labor side and the capital side. And that should be good for growth. That should be good for fiscal. Key issue is, bond supply. And I think that keeping the deficit below 6% of GDP was very welcome.
Taimur, hi, good morning. So you're talking about the positives, right? In terms of consumption, do you think enough was done to boost both rural and urban consumption? Because given the way taxes have been hiked, it looks like it's going to hit the middle class for sure. But do you think enough measures were taken by the government to sort of boost rural and urban consumption?
So I think if we look at the totality of the fiscal measures over the last half a decade, lots have been done to support the mid and the low end of the income spectrum in terms of welfare support. Therefore, I think that we should not expect every budget to sort of ratchet that up. Expenditure to GDP ratios have gone up. Debt GDP ratios are pretty high. We are heading into the world of higher for longer. I don't think this is the time to keep on adding fiscal outlays. I'm pleased to see that the authorities managed to pull off a fiscal arithmetic gymnastic in which no major expenditure item was really sacrificed. But I'm also pleased to see that nothing was ratcheted up substantially, because I think the bond markets worldwide, not just in India, are getting a bit stretched. So you got to be careful about the supply side. And therefore, to me, focusing on the long end of the game, just boost skills, boost productivity, that'll create jobs and income. And that's the right way of supporting the economy, not necessarily softs in the short term.
All right. Hi, Taimur. Good morning. Good to see you. Going by the fiscal prudence that the finance minister has stuck to, do you think India's case for a sovereign credit rating, better sovereign credit rating is on the cards? Has it made our case stronger?
Look at the credit ratings agencies. They remain a bit concerned on the primary deficit as well as the debt GDP ratio. It's going to be hard to pull off major progress in that area unless we see growth upwards of 7%. So that's my back of the envelope calculation, if you will, that for a credit rating upgrade, we would need a firm upwards above 7% forecast for GDP growth. That would help the various ratios, particularly debt service ratio, primary balance, and debt GDP. And that would then start making inroad into the spreadsheet of those credit ratings analysts, if you will, and start flashing marginally green. I think we would need those things before a proper upgrade is coming.
So there were expectations of a further expansion on things like the PLI manufacturing scheme, etc., Taimur, but none of that really showed up this time. Would you construe that as a negative?
No, I think if there were, additional incentives on top of all the incentives that has been provided so far in the last, say, 3 or 4 years, I would have seen that as a sign of worry that it is only about industrial policy and it's only about providing incentives to the sector and protecting it. I would like the sector in manufacturing to be privy to greater competition, recognizing that there are other large manufacturers out there who are very competitive, very productive, and SOPs will not get India into the global picture of manufacturing. It would be productivity and competitiveness, and that would not be driven by SOPs. So therefore, I think that some of the incentive schemes that are in place, in my view, are plenty.
Arvind Sanger is also with us, Taimur. So let's get him into the conversation. Managing partner at Geosphere Capital. Arvind, we spoke yesterday, and good to speak with you again today. So, I was saying in the morning that the Wix sold off yesterday. The India Wix was down some 18%. Sometimes on, day zero of an event, the market reacts a certain way. And then, as things start to seep in, it starts to sour a little bit or, move the other way. Are you expecting anything dramatically different today and over the next couple of days? Because yesterday was just, absolutely flat after all those tax changes.
Well, I mean, I guess let's be clear. Taxes on stocks went up, so we're not going to be jumping for joy for that. Let's be honest about that. And as far as the rest of the budget is concerned, I think fiscal consolidation is happening. That is good. If they're shooting for 4.9%, that's a good sign. There are some, other than the tax increases on capital gains for equity investors, there are, minor positives, minor negatives, but I don't think there was anything barn burner either direction that should cause, any meaningful change. I think, as Taimur, I think, was saying, I think the real challenge now is the private sector has been provided a lot of incentives through the PLR scheme. It has had a tax reduction to 25% a few years ago. Profitability has improved. The CapEx cycle, the baton has to be passed on from government doing all the heavy lifting to at some point the private sector coming in. And that's going to be, this budget wasn't going to dramatically change that. I think that's what we should see in the next leg of the story as it works out. So I think the budget was largely a non-event, except for a minor negative for stock investors.
There is a negative for real estate investors as well, right? While the long-term capital gains tax on property sales was reduced, now you won't get any indexation benefits when you sell your property, which you hold for over 24 months. What does this mean in terms of whether the money will now come to the equity markets? I'm just trying to understand what the ramifications of that would be, Arvind, on a market like equities.
Yeah, well, I mean, I think, look, the financialization of assets was happening anyway. I'm not sure that there was a huge amount of investment capital going into real estate, but to the extent that at the margin it's slightly negative for real estate, it could drive some. But, I think the equity inflows are coming anyway, so I'm not sure this is going to make a big, it's going to be a big catalyst for significant incremental, because I think real estate as an investment class was anyway not, at the top of investors' incremental allocation. So I think that part shouldn't be. I mean, and I think there's one other important point that they did. They did put in a lot of incentives for job creation, which is, I think, a pretty good thing, because one of the problems is job creation, but I'm not sure that incentives alone are the solution, because I think the skilling needed and to make sure that people are trained enough for the jobs that are, going to be offered if you're trying to grow manufacturing, that's also important. So it'll be interesting to see how all of that works out. But I think, in terms of real estate versus equity investors, I'm not sure that there's enough of a thing there to get really excited about. I think the long-term story budgets are, in my opinion, small, paths on the road to what makes us bullish about India long-term.
Sonia, on real estate, right? So for older, so the indexation is gone, right? So that tax impact is larger. That is the sort of understanding. But for further sales in real estate, isn't it a booster? Because if you're an investor and you're buying something now and you sell, you're not paying 20% after 24 months. Earlier, you were paying 20%. Now you're paying 12.5%. I'm saying for future sales.
But even
from
for future
here,
sales, you won't get indexation benefits, right?
No, but if you buy now and you sell within after 3 years, in any case the indexation is not that much. So actually for future sales, for new projects, etc., this actually could be a booster for older legacy property which you already own, which you bought in 2000 or whatever, right? I mean earlier, and you're selling because property values have gone up 10x, whatever. I mean, it could be a significant hit. Tax outgo could be much higher. But for future sales, I think it could be actually a booster. We'll sort of try and understand this way.
I think, Prashant, it's case to case. For example, I was just doing the rough math for a property that my parents sold.
No,
and in
so
fact,
older is good. But now, if you do it now, from today. Then
I'm saying that argument, whether it was good or bad, the change, even if you bought it in early 2000, actually depends on case to case.
Then also it could be marginal.
Exactly.
It could be marginal.
Exactly.
But from here on, I think it's not negative. It actually could be positive from a developer point of view. Taimur and Arvind, great to have both of you here. Appreciate your time.